So what I do is I create a structure where I place these bonds in this that structure, and that structure issues a bond, and any payoffs of that bond depends upon how much you get from those mortgages. If half of those mortgages default, then that's going to be reflected to the investors of that bond. You can do similar stuff with credit card receivables, the company receivables, for example. A lot of companies don't keep their receivables in their books. They actually issue short-term commercial paper based on those. These are kind of modern ways of financing stuff. You could also even make creative structures. The most uh, the simplest one is the senior junior structures. Have you guys ever heard things called subprime mortgages? Anyone? These are mortgages that are issued to people that cannot satisfy federal guidelines for either credit score and or income levels, because if they satisfy those, they can be sold to federal agencies like Fannie Mae or Ginnie Mac, and federal government actually guarantees performance on those mortgages. But if you got a credit score below 640, or you have a debt to income ratio below 40, about 40%, then you don't qualify for those, which means they have to give you a subprime mortgage, which typically have much higher interest rates. And there's a good chance that the people who borrow through those subprime mortgages won't be able to pay them back in full. So if you wanted to sell those to investors, well, not everybody's going to be interested in them. For example, pension funds cannot buy anything that is not rated AA or higher, or regular mutual funds who are not into trading loan risk. They cannot buy anything that is not investment grade, which is triple B. But you could do a structure. For example, if you got $100 million pool, you could go ahead and put $80 million into senior structure, 20 into junior, which means the first 80% of the money that comes into the pool goes to the senior structure. If there is more money coming in, it goes to junior. But if only 80% comes, then junior guys get nothing, right? Which means the senior tranche is a lot less risky compared to the junior tranche, which you can go ahead and get rated AA or higher, which means you can sell a big portion of that to pension funds and investment funds, and you could sell the rest to people who want to trade on high risk loans or keep it in your books. At least the simple structures are relatively easy to price, so we're going to get into those. That's going to be kind of the first 1/3 to 1/3 and a half of the semester. Then starting week 7 or so, we're going to start into CAPM. We'll talk about the risk return trade-off, talk about things like minimum variance portfolios, what sort of portfolios will be held, given that what sort of asset pricing models. And that's kind of going to get us through the spring break. And after spring break, we'll talk about the so-called multi-factor asset pricing models. You'll know what that means when we get there. Then we're going to talk about project cash flows. These are when you have a capital budgeting project, how do you estimate those cash flows? How do you make pro forma financial statements? How do you actually evaluate them? Whether or not you should go ahead with the project. Then in the last third of the semester, we're going to talk about financial statements, the income statements, balance sheet, and statement of cash flows. We're going to talk about how to analyze them, how to basically read them. My usual joke is accountants create the financial statements. The finance people actually read them the way they should be read. There are a lot of things that you should ignore in a financial statement, and there are a lot of things that are not even in the financial statements, but they are available in financial reports provided to SEC. We'll talk about multiples, things like price earnings, price to book. We'll talk about the concepts of enterprise value, EBITDA, and we'll do some basic valuation using multiples. We'll also talk about adjustments for liquid or cash assets when you do these valuations. In the last basically 2-3 lectures, we'll do some optional topics. Okay? That's pretty much the plan. I already talked about what we're going to do for grade. Let me put it this way, unless you give me a reason otherwise, my target is giving everybody an A. So if you're getting a C or a B, that means you pretty much ask for it, okay? And the greatest way to do a C and a B is not to do the assignments. I mean, if you do the assignments, I'll find a way to give you a good grade. And quite a bit of your grade is based on group work anyway. And if you already know 3 people that you want to work with, or including yourself, when we come into the class next time, we'll go ahead and set up those groups. And the first homework probably is going to be sometime next week, so that you can actually start working together. All right? Do you have any questions until now? All right. Let's briefly talk about time value of the money, because outside of 3 of you guys have not taken regular business finance with me, so I don't know to what extent you were exposed to these concepts, and I want to basically bring everybody to the same place. Okay. Time value of the money. Come on. Of course, when I'm also recording and doing Zoom, the resources are being extended. So let's go ahead and, for today, type. Yeah, you want your can, I know. I got these 2 cats. I mean, I don't know if you guys can hear them. Based on the meowing I get, you would think that they haven't eaten in a year. But morning is pretty much when they get their can. Even though there's dry foods, they're still meowing for that. Time value of the money. As I mentioned before, time value of the money is about the concept that $1 today is not the same thing as $1 1 year from today. And let me ask you a question. Suppose I created a scenario. I am guaranteeing that there will not be any inflation in the next year, and I'm good for my word. If you loan me money, you're guaranteed to get it back. I may even, have some sort of security that's going to make sure that's going to happen.